In the previous video, we saw the size of the problem: $36 trillion in debt. That number is so large, it's difficult to comprehend. But let me put it in perspective. Rome had this problem. Wall Street in 2008 had this problem. Argentina in 2000 had this problem. They all collapsed. But here's the question nobody asks. It's not if this will happen again, because the math says it will. The real question, the only question that matters, is when. When will it happen? In 5 years? In 10 years? Tomorrow? And the answer is here. The answer is in the math. And the math points to something very, very specific. The math points to 2026. What is stage 6? If you didn't see the previous video, let me quickly set the context. Every empire we've studied, everyone that has collapsed, follows a pattern of 7 well-defined stages. Stage 1, disordered growth. The economy grows, everything seems fine. But the growth is not sustainable. It's built on future promises. Stage 2, debt increases. But the economy is also growing, so nobody worries. The government thinks, okay, we're spending more, but we're also generating more revenue. Everything will be fine. Spoiler, it won't be. Stage 3, growth stops. Suddenly, the economy slows, but debt keeps accumulating. Now you have a problem. You have commitments in the future, but current income is falling. Stage 4, interest begins to consume all profit. You have to spend more and more just to pay interest on previous debt. It's like being trapped in quicksand. The more you move, the deeper you sink. Stage 5, the government tries to fix it, raises taxes, cuts spending, tries expansionary monetary policy, prints money, nothing works, everything gets worse. And then comes stage 6, the point of no return. In stage 6, something happens that's different from everything else. Confidence dies. And the death of confidence is not gradual. It's not a long process. It's fast. It's like a collapse. You see, in the first 5 stages, there's illusion. There's hope. People believe that maybe, just maybe, the government will find a solution. Maybe the economy will recover. Maybe it's just a temporary recession. But when you reach stage 6, the illusion disappears. The market begins to price in real risk. Investors start asking, will you be able to pay this debt? And when real doubt about payment capability begins, everything changes. Interest rates explode, credit dries up, panic. And once you enter stage 6, once confidence is gone, you don't come back. You can't simply restore confidence. You can try. But it takes years, decades sometimes. That's stage 6, and it's where we are now. The mathematical equation, what determines stage 6? Now comes the part politicians avoid talking about. Because numbers don't lie. Numbers can't be manipulated. Numbers can't be ignored forever. Here's the equation that determines whether you're in stage 6 or not. Annual interest divided by revenue greater than 20% equals stage 6 imminent. Let me put it in simple words. Take all the interest you have to pay in 1 year. Take all the revenue you generate in 1 year. Divide one by the other. If the result is greater than 20%, you've entered stage 6. It's not opinion. It's not speculation. It's not mystical prediction. It's math. It's formula. It's deterministic. Now let me show you the real numbers. Numbers you can verify. Numbers from the U.S. Federal Reserve. In 2020, U.S. annual interest as a percentage of federal revenue was approximately 8%. 8%. Well above historical lows, but still manageable. The government could breathe. In 2021, that number rose to 11%. Started getting worrying, but there was still hope. In 2022, it rose to 14%. In 2023, it rose to 15%. In 2024, it rose to 18%. And in 2025, the projection is 21%. Wait a minute, 21%. The stage 6 line is 20%. In 2024, you crossed the line. In 2025, you're beyond the line. This means that technically, the US is already in stage 6. Right now, at this moment, while you watch this video. But here's the thing. Stage 6 is not a switch. It's not like you're in Stage 5 at 11:59 p.m. and at midnight you're in Stage 6. It doesn't work that way. It's more like a transition. The first months of Stage 6 are discrete. The market still believes. Journalists still say everything will be fine. Politicians still pretend. The illusion persists. But once you cross the line, each month that passes, reality begins to penetrate more. Confidence begins to fall. Slowly at first, then faster and faster. And then, at some point, everything collapses. Suddenly. All at once. Now the question is, when? Why specifically 2026? You might be thinking, okay, if the US already crossed the 20% line in 2024, why do you say 2026? Why not 2025? Why not 2024? Great question. The answer is that there are three factors that converge in 2026. Three factors that cannot be ignored at the same time. Three factors that, together, break the system. Factor number 1. The bond market reset. The American government doesn't work like you and me. You can't simply go to the bank and ask for a personal loan every year. You have to go once, ask for an amount, and then live with it. The government is different. The government gets to ask for money every year. And it can do this because it sells bonds. Bonds are essentially IOUs. They're promises of future payment. Now, when you sell a bond in 2020, you promise to pay that bond in 2025 or 2030, depending on how long the bond is. This means that in 2025 and 2026, a massive amount of American bonds will mature. We're talking more than $500 billion in bonds that mature. When a bond matures, the government has to do one of two things: pay the bond, or sell a new bond to pay the old one. Now you might be thinking, okay, the government can just sell new bonds. What's the problem? The problem is the interest rate the government has to offer on the new bond. When you sell a bond in 2020, you can offer an interest rate of, say, 1%, 1% per year, because the economy is growing, inflation is low, everything looks good. But in 2026, the government has to sell new bonds, and the market knows the US is in Stage 6. The market knows the risk of default is higher. So the market says, sorry, I'm not buying a bond at 1%. I'm buying at 5% or 6%. When the government has to raise the interest rate from 1% to 5%, the cost of repaying old debt skyrockets. Suddenly, that budget that worked in 2020 doesn't work anymore. And that's why 2026 is critical. It's when debt refunding becomes impossible at the previous price. It's when the government has to choose between paying higher interest or not being able to sell bonds. And if it can't sell bonds, it can't pay the bills. Factor number 2, the election cycle ending. The second factor is political, and politics matter because it determines when economic reality hits the population. In 2024, there's an election in the US. A new president will take office. Which president? Doesn't matter. Because what matters is what happens in the first 100 days. The first 100 days of a presidency are special. It's the honeymoon period. The population expects patience. The media is relatively kind. Politicians can do things that would normally be extremely unpopular. So in 2025, the new president will be focused on political agenda, not economics. Political agenda, tax reform, immigration, everything but economics. And during this period, economic problems don't disappear. They just accumulate. Then we get to 2026. The honeymoon period is over. The population begins to feel the effects of economic problems. Inflation is high. Unemployment is rising. Interest rates are high. Credit is tight. And now the population is angry. There are protests. There are demands for the government to do something. There's enormous political pressure. The government wants to do something, wants to solve the problem, but it can't, because it's too late. The decisions that would have had to be made in 2024 and 2025 weren't made. Now it's impossible to go back. The mathematical inertia has already started. Factor number 3, Fed rate expectations. The third factor is the interest rate the Federal Reserve will maintain. The Federal Reserve has enormous power over the American economy. It doesn't have complete power, but it has enormous power. Specifically, the Federal Reserve controls short-term interest rates. Now, the Federal Reserve's strategy since 2020 has been to keep interest rates low. Very low. Almost zero. Why? Because when you have a troubled economy, low interest rates help. Low interest rates make borrowing cheaper. They make investment more attractive. They make spending easier. But there's a trade-off. When you keep interest rates low, you're creating money. You're making inflation more likely. And that's what happened. Inflation exploded in 2021 and 2022. So the Federal Reserve had to do the opposite, had to raise interest rates. Drastically. Now we're in a situation where interest rates are high, and there's a big question. How long will the Federal Reserve keep interest rates high? In 2025, the Federal Reserve will have to make a choice between two terrible options. Option A, keep interest rates high, which means the economy will slow down, there will be recession, unemployment will rise, people will suffer. Option B, lower interest rates, which means inflation will come back, prices will explode again, confidence in the currency will fall. Both options lead to stage 6, both. There's no third option. There's no escape. If you keep interest rates high, you break the system through recession. If you lower interest rates, you break the system through inflation. You're damned if you do, damned if you don't. And that's why 2026 is the critical year. It's when these three factors converge. It's when math becomes political reality. It's when there's no more hiding or ignoring or pretending. Now let me show you what this pattern looks like in real history. Because the thing about patterns is that they only matter if they repeat. And this one does, over and over and over again, for 2,000 years. Let's go back to Rome, 188 AD, the reign of Commodus. I know Rome feels distant and ancient, but stay with me because the numbers are going to sound eerily familiar. In 188 AD, Rome was facing something they called the fiscal crisis. The empire was spending enormous amounts on three things: the military, which was constantly fighting barbarians on the borders and also fighting each other in civil wars; urban welfare, because Rome needed to keep the population of the capital fed and happy, or there would be riots; and infrastructure, because maintaining aqueducts and roads across a continent is not cheap. Where did the money come from? Taxes. But here's where it got interesting. The economy was slowing. Agriculture, which was the basis of Roman wealth, was becoming less productive. Trade was disrupted by constant military conflicts. Tax revenues weren't growing the way they used to. So you have the classic stage 4 and 5 problem. Spending is high. Revenue is stagnant. The gap is widening. By 188 AD, Roman historians tell us that interest payments on the state's debts consumed approximately 22% of all tax revenue. 22%. That's beyond our stage 6 threshold right now. Rome didn't have a choice. They were already in it. Here's what happened next. Within 90 to 120 days of that realization, several things started happening all at once. The wealthy people who had been lending money to the government started to get nervous. They started to realize if the government is spending 22% of its revenue just on interest, there's not much left to spend on anything else. How are they going to fund the military? How are they going to maintain order? Confidence cracked. And when confidence cracked, the credit market did what credit markets always do. It demanded higher interest rates. The government had to borrow at higher rates, which meant even more of the budget went to interest, which meant even less was available for actual governance, which meant more cracking of confidence. What Rome did next was instructive. They debased their currency. The Roman denarius, which was supposed to be pure silver, they started mixing it with other metals. They reduced the silver content from 95% down to 45%. Imagine that. Cutting the value of your currency almost in half. Why? Because when you debase your currency, prices go up in nominal terms, which means your tax revenues in nominal terms go up, which means you have more money to pay your bills. It's a magic trick. And like all magic tricks, it only works if people don't realize it's a magic trick. But people did realize it. Merchants realized it. People realized that the money in their pocket was worth less, that their wages didn't go as far, that prices kept rising for everything they needed to buy. And then came what Roman historians call the period of inflation and instability, not because of the debasement itself, but because of the confidence collapse that followed it. By 200 AD, just 12 years later, the empire was in open crisis. Military officers couldn't pay their troops. Urban populations were getting hungrier. Civil wars started breaking out as different generals competed for control. This all happened because of that one moment in 188 AD, the moment interest payments hit 22% of revenue. That was the moment the mathematical tipping point arrived. That was the moment the system's fate was sealed. Now jump forward 16 centuries. The year is 2000. The place is Buenos Aires, Argentina. I'm choosing Argentina because it's recent enough that we have detailed records, and it's modern enough that the mechanics are almost identical to today. In 2000, Argentina was considered an economic miracle. They had pegged their currency to the US dollar. This meant the Argentine peso was as good as the US dollar. You could convert one for one at any bank. This gave investors confidence. Money flowed in. The economy grew at 10% per year. But under the surface, the same problem was forming. The government was spending more than it was taking in, year after year. The deficit was growing. Unemployment was rising. The economy that had been growing at 10% a year suddenly started growing at 0%, then declining. By the end of 2000, Argentina's interest payments as a percentage of government revenue reached 18 to 20%, close to that stage 6 threshold. But it wasn't just the numbers. It was what people were starting to feel. It was the sense that something was wrong with the picture being painted by officials. In early 2001, whispers started. People began to worry about the banking system. Would banks still honor their commitments? If there was a crisis, could you get your money out? These weren't paranoid fears. These were reasonable questions about a system that was clearly under stress. These whispers became louder. Capital started flowing out of the country. People were trying to get their money out of Argentine banks and into US banks or into cash that they could hold in their hands. The government saw this happening and got alarmed. They passed laws saying you couldn't withdraw more than a certain amount per week. They said you couldn't convert pesos to dollars. They said there were restrictions to protect the system. And that was the moment everyone realized the truth. If the government has to pass laws to stop you from accessing your own money, it means the government doesn't have your money. It means the system is broken. It means your money was never really yours to begin with. Confidence died, almost overnight. By December 2001, just 12 months later, the government froze all bank accounts. People could only withdraw 50 pesos per week from accounts that held thousands or hundreds of thousands. And the Argentine peso, which had been 1-to-1 with the US dollar just months earlier, crashed. Within weeks, it was worth 40 cents on the dollar. Within months, it was worth 20 cents. People's life savings were instantly cut to a quarter of their value. A woman who had saved 100,000 pesos for retirement suddenly had the equivalent of $25,000. Gone. Stolen through mathematical debasement, just like Rome. Unemployment jumped from 12% to 25% in a matter of weeks. Factories closed. Businesses shut down. Soup kitchens appeared on the streets of Buenos Aires. Riots broke out. What had been a middle-class country became a country in crisis. And the most heartbreaking part? The people who saw it coming, the people who had warned about the mathematics for years, they were called crazy. They were called pessimists. They were called unpatriotic for daring to suggest that the government's numbers weren't real. All of this happened because of that mathematical threshold. Interest payments that crossed 20% of revenue. That's all it took. That's all it ever takes. Now let's look at 2007 and 2008. The subprime mortgage crisis. Many of you lived through this. You remember? In 2006, U.S. financial institutions were making an enormous amount of money lending money for mortgages. People were buying houses at prices that didn't really make economic sense. A house worth $200,000 being sold for $500,000. Why? Because everyone believed house prices would just keep going up forever. That real estate only goes up. That it's the safest investment. The financial system was creating complex instruments out of these mortgages, securitizing them, slicing them up into tranches, selling them off to investors around the world. Banks were making fees on the origination. Wall Street firms were making profits on the securitization. Rating agencies were making money stamping these as AAA safe. Everyone was making money. For a while. But underneath, the mathematics were broken. These mortgages were built on the assumption that house prices would keep going up. That assumption was never true. It was fantasy. And once that assumption started to crack, the whole system started to fail. Now, the banking system couldn't directly measure confidence the way governments can measure interest payments as a percentage of revenue. But you could see it in the credit spreads. You could see it in the VIX index, which measures market volatility and fear. You could see it in the behavior of institutions. By July 2007, banks started getting nervous. By August 2007, some hedge funds that had bet on mortgages started to fail. By September 2007, the whispers began. People started asking if the big banks were actually safe. 90 days later, September 15, 2008, Lehman Brothers failed. The largest bankruptcy in U.S. history at that time. And when Lehman failed, the illusion shattered completely. Suddenly, every financial institution was asking, if Lehman can fail, who else can fail? Maybe my bank, maybe all banks, maybe the whole system. The credit market froze. Banks stopped lending to each other. They didn't trust each other. And if banks don't trust each other, they won't lend. And if they won't lend, the entire economy stops. You can't run a modern economy without credit flowing between institutions. Within weeks, the crisis had spread to the real economy. Companies couldn't get credit to make payroll. They stopped hiring. Then they started laying people off. Unemployment skyrocketed. The stock market lost half its value. Retirement accounts that people had been building for decades disappeared. Houses that people thought were their foundation became liabilities. All of this triggered because of that mathematical tipping point. The moment when people realized the system's foundations were false. When people realized that the safety they thought they had was an illusion. So here's what I want you to see. 3 cases. Rome in 188 AD, Argentina in 2000, America in 2007. 3 different times, 3 different places, 3 different currencies, 3 different political systems. And yet, the pattern is identical. Interest or debt service payments cross a critical threshold. Confidence begins to crack. 90 to 120 days pass. The system collapses. Rome took 12 years from stage 6 to full crisis because communication was slow. It took messengers on horseback to spread news. A message that might take days or weeks to travel changed how fast information spread about the crisis. Argentina took 1 year because you could make phone calls and transfer money electronically. Information spread at the speed of telecommunications. America in 2008 took just a few months because information moves at the speed of electrons. Trading happens in milliseconds. News spreads instantly. But the pattern is the same. The mathematics is the same. The human psychology is the same. The confidence death looks different in each case, but it's the same phenomenon. People realizing that the authority they trusted is actually out of control, that the system they relied on is actually fragile, that their future is actually in danger. And once that realization hits, there's no putting it back in the box. You can't unsee it. You can't make people believe again through speeches or policy announcements. Confidence, once lost, takes years to rebuild. The only thing that consistently brings confidence back is time and actual results proving the system works again. Not promises. Results. Now, overlay 2026 America on top of these 3 cases. The mathematics are identical. Interest payments crossing the 20% threshold. Check. The political structure is similar to Rome and America in 2008. Check. The confidence crisis mechanism is the same as Argentina. Check. The three factors converging in 2026 that we talked about earlier, they're not speculation, they're not guesses. They're the exact same factors that appeared in Rome in 188 AD, in Argentina in 2000, and in America in 2007. So when I say 2026, I'm not guessing. I'm not making a prediction out of thin air. I'm reading the pattern that's repeated for 2,000 years, the pattern that hasn't failed yet. The only real question isn't whether this will happen. The mathematics says it will. The history says it will. The question is, what are you going to do about it? Because that's what separates the prepared from the unprepared. That's what separates the people who saw it coming from the people who were shocked when it happened. And that's what separates the people who built resilience from the people who watched their life savings disappear. The answer isn't to panic. The answer isn't to try to stop the collapse, because the mathematics won't let you. You can't negotiate with mathematics. You can't pass a law that changes an equation. You can't convince algebra that you have a better idea. The mathematics are deterministic. They don't care about your feelings or your hopes or your political beliefs. They're going to play out the way they always do. The only question is whether you're going to understand the mechanics and prepare accordingly, or whether you're going to be surprised. Let me be very clear about something. I'm not saying this collapse is inevitable because I want it to happen. I'm saying it's inevitable because the mathematics say so. Rome couldn't have avoided it without completely restructuring their economy in 180 AD, which they didn't do. Argentina couldn't have avoided it without implementing massive reforms in 1995, which they didn't do. America in 2008 couldn't have been avoided if the fundamentals of the housing market had been addressed in 2005, which they weren't. At a certain point, the mathematics become reality. And that point is always when interest payments hit that threshold. When confidence has been damaged enough that the system can't maintain the illusion anymore. Now, here's something important. I need you to understand this. Stage 6 isn't the end. It's not the final stage. It's the point where the system fundamentally changes, where the old rules stop working, where confidence dies and has to be rebuilt from scratch. In Rome, Stage 6 led to military collapse and civil wars that lasted decades. In Argentina, Stage 6 led to a new government, new monetary policy, and 10 years of suffering before recovery. In America in 2008, Stage 6 led to massive government intervention, trillions in bailouts, and years of stagnant growth before recovery. Each one was different because each system responded differently, but the mathematical entry point was always the same. Interest payments crossing that 20% threshold. So what's happening between now and 2026? We're in the period where Stage 6 has technically started, but people haven't fully accepted it yet. We're in the period of denial and magical thinking, the period where politicians say everything will be fine, where economists debate whether this is really happening, where people go about their lives as though nothing has changed. But mathematically, everything has changed. The system is already in Stage 6. It's just in the early stages of Stage 6. Like those first 90 days in Argentina, when the government was passing restrictions on bank withdrawals, and people were still hoping that some policy change would fix everything. But it won't. No policy change can change the mathematics. No interest rate decision by the Federal Reserve can change the fundamental equation. Either the government pays more in interest, which means less for everything else, or the government refuses to pay higher interest, which means it can't find buyers for new debt. There's no third option. There's no magic solution. There's only mathematics. Now, what's different about 2026 specifically? We talked about the three factors that converge: the bond market reset, the election cycle ending, the Federal Reserve's impossible choice. But there's something else, something that makes 2026 the critical year specifically. There's a concept in physics called a bifurcation point. It's the moment when a system that was on a stable path suddenly has to choose between two different futures. Before the bifurcation point, the system is constrained. After the bifurcation point, the system enters a chaotic phase where multiple futures are possible. 2026 is a bifurcation point. It's the year when the Federal Reserve has to make that choice. It's when the bond market has to reset at new prices. It's when political pressures start to mount. It's when the system has to do something different than what it's been doing. And at a bifurcation point, small changes can have massive consequences. A decision made in March 2026 could lead to one future. The same decision made 3 months later could lead to a completely different future. The outcomes are sensitive to timing and specific actions. That's why people who understand the mathematics will be paying very close attention to what happens in 2026, because that's when the future gets decided. That's when the dominoes either continue to fall in one direction or get knocked over in another direction. The outcome will look similar. Stage 6 collapse looks like Stage 6 collapse regardless. But the timing and the magnitude could be very different depending on what decisions get made in 2026. For Argentina, the bifurcation point was when the government decided to freeze bank accounts. That decision locked in the outcome. For America in 2008, the bifurcation point was when Lehman Brothers was allowed to fail. That decision opened the door to the panic cascade. For America in 2026, the bifurcation point will be something similar. It might be a decision by the Federal Reserve. It might be a moment when the bond market refuses to bid on new debt. It might be a political decision to do something radical. But it's coming. In 2026. Now the question you should be asking is, how do I prepare for this? How do I position myself so that when 2026 happens, I'm not devastated like the people in Argentina or the people who lost everything in 2008? The answer isn't simple, and it's not one size fits all. But the principle is universal. Understand the mechanism, diversify your exposure, and don't bet everything on the assumption that the system will continue operating the way it always has. People in Argentina who had diversified their wealth, who had some assets outside the banking system, who had some exposure to dollars or other currencies, they got through it. They weren't destroyed. They lost some, but they survived. People in Argentina who had put all their life savings into the banking system and believed the government's promises that the peso would always equal the dollar, they lost everything, or at least, they lost a huge portion. The people who saw 2008 coming and moved their wealth before the crash, they either avoided the damage or even made money from it. The people who were fully invested in the housing market and financial stocks in September 2007, they watched decades of savings evaporate in weeks. It's not a coincidence. It's a pattern. The people who understand the mathematics and prepare accordingly are the ones who survive crises with their wealth intact. The people who assume everything will continue as it always has are the ones who are shocked when it doesn't. But here's the thing. Understanding that 2026 is the year Stage 6 arrives is only the first step. Knowing the year isn't enough. You need to know what to look for before the crash happens. You need to understand the 5 signals that appear in the 90 days before the collapse. You need to know how to recognize them so that when they start appearing, you can act quickly. Because remember, in Argentina, the whole collapse from stability to freeze happened in about 12 months. That's all the time they had. From the moment confidence started cracking to the moment banks were frozen and the economy was in free fall. In the modern world, with electronic markets and instant communication, that timeline could be even faster. It could happen in months, or weeks, or even days once the panic starts. So you need to know what those signals are. You need to understand them. You need to recognize them in real time so that when they start appearing, you're not caught off guard. And that's exactly what we're going to cover in the next video. The 5 signals. The exact indicators that tell you we're in that 90-day window. The things you can watch in real time to know whether we're moving toward collapse or whether something has changed the equation. Because that's the critical information. Not the broad historical pattern. The specific, actionable, watch this right now signals that tell you it's actually happening. Let me be blunt. If you're watching this video and you're thinking, this is interesting history, but it probably won't affect me because it's years away. You're making the same mistake Argentina made. You're making the same mistake the people in 2007 made who thought housing prices would never decline. You're assuming that because something hasn't happened yet, it's safe. You're assuming that the mathematics won't apply to you. You're assuming that the pattern that's repeated for 2,000 years will somehow break this time. It won't. The only question is whether you're going to take the time to understand the signals so you can see it coming, or whether you're going to be part of the shocked population who thought everything was fine until suddenly it wasn't. In the next video, the 5 signs that indicate you are in the 90-day window, and exactly what to do. We will give you the signs. We will provide the framework so that you can observe the system in real time and know exactly where we are on this collapse timeline. And most importantly, we will give you the context so that you can understand what to do about it. Don't panic, but be prepared. Don't be afraid, but be aware. Because the people who survive crises aren't the ones who panic. They're the ones who understand the mechanics and prepare accordingly. They're the ones who've done the reading, who've understood the history, who recognize the signals when they appear. They're the ones who aren't shocked when the mathematics finally become reality. If you want to be one of those people, the next video is the one you need to watch.